And of course, this changes over time. When we first started doing deals, there were a whole lot of 60-40 splits.
60-40s. Oh my gosh, I did so many of those.
And then we went to 65-35, right?
Yeah.
And then eventually 70-30. And so it changes, shifts with the economic time period that we're in and how much meat is left on the bone, for the management and for investors. So, a lot of times we have clients who come to us that don't understand how to figure out what portion they get.
Yeah.
Right. And so that really starts with your deal analysis.
Correct.
Right.
Yeah.
So, I'm sure you can expound on this much better than I can, but the way that I explain it to people is I say, you have to look at the overall cash on cash return for that property. So how much cash are you putting into it? Not the loan, but how much cash do you have to raise from investors and whatever money you're going to put in? Pile all that in one pile. How much of a return is that generating annually?
And so maybe cash on cash
return.
Yeah, which includes like the down payment, the legal fees, of course, the escrows. Those are big, for the insurance, of course, taxes escrows, and even CapEx escrows. All those monies that we have to raise to complete the deal. So
and the acquisition fee.
And acquisition fee,
And the acquisition fee that gets paid to the management, right?
Exactly.
So you've got to add all that up in order to determine how much cash you need to do the deal. Correct. And then figure out, all right, so based on the amount of income I'm going to generate every year, and you figure that out for 5 to 7 years, then how much is that going to generate as a cash on cash return over that money that we raised? And so once you know what the overall cash on cash return is, then you can say, well, how much do I have to give to investors in order to be competitive?
Yep.
And so investors are typically looking for an annualized return of somewhere in the mid to high teens range.
Yes. Yeah.
Mid to high teens. So part of that could come from some money that you're going to give them when you're sharing cash flow. Right. So you're going to quarterly, you'll make distributions from cash flow. So as you're collecting rent, you're going to pay off you're going to pay your debt service, and you're going to pay your monthly operating expenses, and you're going to pay the asset management fees that we talked about to the management of the GP. Then you're going to determine how much cash is left over. We call that distributable cash. How much of the distributable cash is left. And then from that, you would try to pay your investors. You would pay them something first, and then maybe the management would get something. But there's usually going to be some kind of a split there that's going to follow your ownership structure. But it could be skewed in a way that you're going to make sure that the investors get a certain hurdle rate, a certain annual return before the management takes its cut. So that's called a preferred return. So let's say we were going to give investors 8% per year, then quarterly you would try to give them 2% on their money. But what if in the first 2 years you don't have enough? You only are making 6% return because you're doing improvements and you have to do stuff to the property before you're going to be able to share that. To have anything to share with investors. So you might give them 100% of the distributable cash for the first couple of years. And with that, they would go ahead and, get part of their preferred return. Part of it would be deferred until you have enough cash flow. And then you would make that up at some point in the future, either from a refinance or a sale, or maybe from future cash flow. So the goal is to split. Let's say if you're doing a 70-30 split with investors, the goal is to split 70-30 all the time, and hopefully they'll get their 8% out of the 70% you're giving them. But if that's not happening, then you might have to give up a little of your 30% to get them there for a few years until the property generates enough cash on cash return that everybody, a 70-30 split, gets them their 8. And then later, when you sell the property, then you're going to have some equity because the property, you've done things to the property to cause it to appreciate in value, and you've paid down some of the loan, and all of these things have helped, and the market has changed. And so you're going to get a much bigger offer, hopefully, by the time you go to sell than what you put into it. And so that becomes equity. So when you sell the property, then you would pay first all the operating expenses of the company, including any deferred fees for management. You pay off the loan, of course, for the lender. And then what you have, you hold some money in reserves to make sure you don't have any outstanding bills coming due. And then you would go ahead and make a distribution to your investors. So you'd first pay back their original capital contribution. So whatever has not been paid back, they get their money back first.
Yep.
And then secondly, you would make up any arrearages in their preferred returns.
Yep.
So if you've been deficient in a couple of years on those preferred returns, you look all the way back to the beginning, you make that up. And then you might pay something to management. So there could be a catch up for management. Sometimes our clients do that. And then the rest would be split. And sometimes you'll even have like an upper hurdle where you would say, well, once the investors have all their money back, plus they've gotten a 17% IRR, then the split's going to change. It's not 70-30 anymore.
50-50.
50-50, maybe it's even 30-70.
30-70, sure. Other way around. Yep. Yeah.
So that's very, very common. We see a lot of that.
Excellent. What simple ways. You just took us through the whole thing. No, thank you so much. Thank you, Kim. Can we talk something about some challenges that the new investors, syndicators face? I know money raising is one challenge. What do you see in talking to so many of them? What are some things they can pass through hurdles, let's say, in their belief system is one, and not having enough investors, not bringing the due diligence, is another one which can hurt them because they shelled out money so much and they didn't really underwrite the deal that good. So I'll let you kind of speak on that subject. Yeah.
Yeah. Well, so the first chapter of my book is about mindset. So it's all about, if you can't get past the mindset that you're borrowing money from somebody for something that's only going to benefit you, then you're never going to be able to raise money successfully. So you've got to realize that you're offering investors an investment that they need.
Yeah.
So you're offering them an opportunity. You're not asking them for a favor. And so once you can flip that mindset, then I think you're in a much better position to be able to raise the money. If you can't, then you just need to find other people on your team that can do that and get them to raise the money, right? Because there's lots of roles in management, right? There are people who find the deals.
Yeah.
There are people who conduct due diligence and do the
underwriting.
They do the underwriting. People who actually physically go to the property and conduct due diligence and work with the property inspectors and do the lease audits and all of those things. Then there's the asset management role. So this is the role of where the people in management are.
Hi, you are listening to Syndication Made Easy podcast. We will be right back after this short break.
Hi, thank you so much. This is Vinney Chopra, and thank you for subscribing to my podcast and YouTube channel and Facebook pages and all the great things, and LinkedIn. Connect with me. I come live to you every Friday at 9:30 Pacific with Vinney and Bo show. Please also look at that. And also the podcast, which is my Apartment Syndication Made Easy. The book I wrote a couple of years back became international top seller on Amazon International now. And then we like to bring great guests for you every week or twice a week sometime to give you a lot of great knowledge. So please subscribe. You give us 5-star reviews on the iTunes. The better the guests we can bring, and our ranking will go higher also. Thanks again for following us and really getting the most out of it. Please comment, like, share, because we would love to bring better and better material for you.
So this is the role of where the people in management are constantly on the phone with the property managers, right? So there's a distinction between an asset manager and a property manager. A property manager is the one who's on site dealing with the tenants and the tenant issues. They always say tenants, toilets, and trash, right? They're the ones that are dealing with the
day-to-day ups and downs.
Tenant issues. But the asset manager's role is to oversee the property managers, help solve any problems that have to be solved at the ownership level, and then to report back to the investors. And to explain to the investors what's happening at the property and to be able to share those profits with them. So there's really two different roles for asset manager versus property manager. It doesn't mean that your company, you could have your own company that provides property management, as I know you do, Vinney, right?
Yep.
Right. But you're going to hire them. You're going to have this investment, the syndicate, hire them separately under a separate property management contract versus what you're going to do as the asset manager.
And we pay like about 3.5%, usually in the 100+ category, or less than 100, like in 60s, 50s, and 40s, even 7%, 7 or 8% monthly revenues go to the property management company.
Right. And then you have loan guarantors. So who are the other people? We've got to have some people that are going to guarantee the loans. And so even when you have a non-recourse loan, you still have to have people with the collective net worth on your management team that the investors can, or the lender can underwrite to determine whether or not they should loan the money to your company. So they want to know if you're, getting a loan for $14 million, then you need to have people with $14 million worth of collective net worth in your management of your syndicate. And again, this is where we would use, if there were only a couple people that were going to be loan guarantors, then we would put them in the manager of the management syndicate or structure. And then that would satisfy the lender that they are the ones who are, going to be making the ultimate decisions about the property. So that all works. And then there's one last role. So we've talked about 4 roles, 5 roles, deal finders, deal analysis, due diligence, asset managers, loan guarantors, and capital raisers. All right. So everybody in management should have a job of raising money.
Exactly.
Everybody has to raise money, and nobody should have a specific job whose only job is to raise the money. That's kind of an SEC no-no. And the reason for that is that you have to have an active role in management other than raising money, and that's what you're getting compensated for.
Sure.
If you are only getting compensated for raising the money, that would actually require you to have a securities broker dealer's license, which is very, very challenging and difficult to get. So you want to make sure that you have another job in management other than raising money. Raising money is just part of everybody's job, and nobody has a formula that says, oh, if I raised $1 million, we plug in this number and this is how much I get out of the management earnings. So you carve out all those roles. So people are going to be, there's going to be, a lot of overlap, right? So the people who found the deal could also be doing the deal analysis and the due diligence, right? And the asset management, right? So they get all of, whatever carve out you've carved out in management for those roles would go to the people that are doing those jobs. And everybody should be part of the capital raising, of course, so we shouldn't have a separate job for that. But I will tell you that there are some rules of thumb. Okay. So the way that I've seen it, and Vinney, you might tell me that you've done it differently, but the way that I've seen it is that the people that are, I kind of lump the deal finders, deal analysis, due diligence, and asset management in one. To me, that's worth 50% of the management earnings. And the asset management has to get the bulk of the earnings because they're in this for the long haul. They have to work on this property week after week, month after month for years. And so they have to have enough of the management earnings to be able to stay engaged without having to go out and look for other jobs or to get so many other deals that they don't have time to deal with this one because they're not making enough money. So these people, that's 50% in my opinion. The loan guarantors, you could either pay them a flat fee or you can give them a percent of the loan amount. And it could be divided up amongst more than one person if people are pooling their collective net worth. So that's 1% to 2% of the loan amount is not unusual for a loan guarantor fee, but then also they usually get some share of the profits. So that could be anywhere, I've seen anywhere from 5% to 25%.
So true, because they are on the hook until we sell the property. I mean, it's a long-term, just like asset managers, the loan guarantors also, even though they won't get too much involved, a little bit, but they will be staying there until the end, right?
That's right. And they can't leave, because if they did, then you'd have to find a substitute guarantor.
Yeah.
And so they are stuck until the end. And then the capital raising, I've seen that be, 25% kind of allocated. And again, that's going to be divided up amongst all the members of the management team that are providing those services. And you really shouldn't have people who are just raising capital and not doing anything else.
So true. So true. Now, let me ask you a question. I know we have heard, and I've had done also, where fund of a fund. So if somebody's kind of raising money with their teams or people they know, then they could invest that fund into another fund. Is that right? That's a structure.
You can, but there's some wrinkles here. Okay. And one of them is that so there's several exemptions that are applying to real estate syndicates. Okay. Yeah. One of them is this exemption related to how they're raising the money. Okay. That's the Rule 506B, Rule 506C. And so those are the securities exemptions from the 1933 Securities Act. Then there's also the Investment Company Act of 1940 and the Investment Advisors Act of 1940. And so the Investment Company Act of 1940, you have to make sure that you're not doing something that would cause you to have to register as an investment company. Mm-hmm. And so there is an exemption for real estate. So if you're buying real estate and you're directly owning the real estate and you're in control of it, then you don't have to register as an investment company. But if you're not in direct control of the real estate, so you're creating a fund of funds that's going to invest as a passive investor in somebody else's deal, then you may not meet that exemption anymore. So then you'd have to look, you won't meet the real estate exception. So you may have to find in a different exception that would apply to what you're doing. And there is one that's called a 99 investor rule. That's exemption 3C1. And then there's another one that is related to, venture capitalists. So it's a little different animal. But you've got to make sure that you're still exempt from having to register as an investment company. And what happens next then is that you could meet that 99 investor rule, but now because you are investing in securities that someone else is selling, okay, you're not investing directly in real estate.
Right.
Real estate aren't securities, so that's why the exception. Now you're investing in securities someone else is offering. Now you're going to have to register as an investment advisor. And so there's different levels of compliance that are required when you fall into the realm of having to be an investment advisor under the Investment Advisors Act of 1940. And so there's one, if you have less than $25 million under assets under management, then you have a kind of a simplified form that can be filed with the SEC, but then you may have to register at your state level. And the state level is where you physically are located.
I see.
And then there could be some additional rules that apply to who you can offer investments to and how you can be compensated that could kind of screw up your ability to participate in these deals. So funds of funds sounds like a great idea, not as easy to execute as everybody thinks. It adds some significant complications. Your goal should not become an investment advisor or a securities broker dealer unless you want that to be your whole-time job and you are not, going to be a real estate syndicator.
So true. And you have to go through some couple of certifications, right? If you
may have to at some point get certified. You may have to take some state tests. You could, there will be some compliance and some annual filing requirements. You might have to get insurance. You might be restricted on how you can be compensated. There might be some different levels of investors that you're able to place in deals. So all of a sudden, the accredited and non-accredited aren't the only rules you have to follow. You might have to follow some additional rules, and they could be higher dollar limits. So there's all, it kind of just opens up that whole can of worms. So the best thing to do is to get directly into somebody's deal in management and send your investors to their deal maybe you have a non-compete agreement or a non-disclosure agreement where the other people in the deal won't solicit your investors for future deals without you involved. And that's probably the easiest way to protect yourself.
Easy and the best way. Again, we don't want to open up can of worm, but I mean, we are treading waters. A lot of people I see on social media, other places, hey, I'm raising money for so-and-so, right? They send the deal to the people. So, I mean, these are 506B deals. They cannot be advertised and all that, right? Can we touch on that? I mean, we don't want to scare people, but, we are treading, on a borderline there.
Yeah. So that you can't. So if they're doing a 506B offering, so we talked about those rules a little bit earlier, but just to kind of recap them, you can raise an unlimited amount of money from an unlimited number of accredited investors and up to 35 non-accredited but sophisticated investors. But you can't find them through any means of general advertising or solicitation. That means no posting on social media, no posting on a bulletin board at your golf club, no, it's one-on-one word of mouth. People that hey, I'm working on this deal. We've known each other for a long time, and I want to be able to offer you this investment opportunity. But even before that, you have to have a conversation with them to determine their suitability.
Their goals and everything, suitability, have it track, written down logs. I remember.
That's right.
Yes.
So there's an article on our website that explains all of this. It sounds complicated, but it's not. So go to syndicationattorneys.com, into the library, select articles. It's one of the first articles, and it's called How to Create a Substantive Relationship. If you read that, it gives you some example questions. If you go through that questionnaire and you have a record-keeping system where you have to be able to document when you learned that information about that person, and what you learned about that person, it's only from that point forward can you offer them 506B investments. And I want to tell you an example of something that happened to me just last week. I attended a seminar, just a virtual seminar, and then somebody sent me the very next day, hey, we've still got some openings available in our 506B deal. And I have a little thing that I send to people saying, hey, you're not my client, but perhaps you should be because you may not be able to solicit this way. And they came back to me and said, well, I've met you at 2 live events and you were just on my, podcast, but the podcast wasn't even about their deal. It was like, and I said, but that's not sufficient. So what's interesting to me is that when I get into these conversations with people, and sometimes they try to argue with me that they have this substantive relationship and they're like, well, it's a gray area. And it's like, no, it's not. The SEC has very specifically stated, you have to know this information about this person. You have to have documented it. And only after that, do you have the right substantive relationship to be able to offer them investment opportunities? And I would argue even further that it doesn't matter if you can advertise. If you do a 506C offering and you advertise, if you take these same steps with every single investor, regardless of whether you found them through advertising or you didn't, that you will then begin to develop a significant enough a relationship that they actually will invest with you. Right. And so until you take those steps anyway, they're probably not going to invest with you because, you've got to be interested in them and making sure this is a good fit for them. And if you're not doing that up front, then you could end up with somebody who's, just a big pain to be in your deal because they don't understand and they weren't suitable and they're relying on your quarterly checks to pay their rent or something. You don't want to be responsible for someone's lifestyle, and you need to make sure that they can afford to lose the money and that it's not going to have a devastating impact on them if they do. And if you find out through the course of that suitability conversation that either of those things are true, then you just have to rule them out as they're not suitable. Doesn't mean they won't be 3 or 4 years from now after they've accumulated a little more money, but don't take some last $50,000.
So true. So true, so true. My gosh, Kim, we can talk for hours and hours. Just so much bundle of nuggets, and you've given audience so much. Guys, anything else last, and how can people reach you? Please tell us that.
So the best way to reach out to us is through our website at syndicationattorneys.com. There's a place there where you can schedule an appointment with one of our staff. But also, I would encourage you to download my book. So my book is free. The digital copy you can get for free at syndicationattorneys.com. There's a tab there that says free book. So go ahead and get that. If you want to get the Amazon version, you can buy it on Amazon, either in the softcover or Kindle. And then, do read the book. Check out the library. There's over 50 different articles there, 1 and 2 pages. There's also a bunch of frequently asked questions. So whenever I start answering the same question over and over, I'll post it. And then we do have a podcast that's on 20 different podcast platforms called Raise Private Money Legally. So all of our, we've been recording our podcast for over 5 years. So there's over 50 episodes, all different aspects of syndication. You'll hear Vinney on a couple of them.
Yes.
You can get a wealth of information. We always try to interview people that add value to our clients and the things they're trying to accomplish. And there's been some pretty spectacular guests, Vinney included.
Thank you, Kim. You are just bundle of energy. I'm so thankful to you. Thanks for hanging out with me today. And it's such a pleasure. I think we covered so many great topics. And hey, guys, if you like the content, please share this episode. Give us comments. Give us 5-star reviews on iTunes. I read every single review and even thank, people publicly, read some of the reviews also in my podcast. The key thing is we want you to be really, really ready to go into this business. Again, we're talking about multifamily quite a bit, but this syndication, you can raise money for anything. I'm buying hotels. I'm building senior assisted livings with syndication, and I'm buying, what else? We're thinking about starting a fund, venture capitalist fund now into my other business. Go ahead. What did you say?
I have a client who's buying corporate jets.
Corporate jet, look at that. Actually, that's 100% write-off. You can have jets, you can have helicopters or heavy equipment like over 6,000 pounds. I'm not CPA or attorney, but that's what, you're so right. But thanks for spending this time with us in the car or otherwise, and give us that 5-star review, and we'll see you next time. Thank you, Kim, so much. It was such a pleasure, and we'll do it again, and give more knowledge and more different things to our audiences.